Let's continue from where we were last class. We were talking about building a portfolio from scratch. So we spent some time talking about philosophy. And again, I encourage you, write down your own philosophy. If you have to borrow from somebody else, and try to put it in your own words. Have some philosophy, knowing that you're definitely going to change your mind over time as you get experience, but just put something down to get started. Once you have a philosophy, say, this is what I believe. These are the type of stocks I think will beat the market if I buy them, and this is how I identify them, this is how I define them. Then you need a process. So how do you actually get the stocks that meet your criteria? That's called screening. Screening is usually done with computers, with Bloomberg or some other screening model. Bloomberg itself has a stock screening model. A lot of brokers have stock screening models that you can put in your criteria. So all this stuff that you identified in your philosophy, you want to get that down to nuts and bolts. So exactly what that means. If you're talking valuation, does that mean you want stocks with low PE ratios? If you're talking about technicals, are you saying I want stocks with a good momentum, which might mean that their current price is above their 50-day moving average, something like that. Um, if you want high quality stocks, then you want stocks that have low debt ratios, but something that you can actually screen on. We talked about quality of management. Management quality is really hard to screen on using a computer. You have to do that essentially manually, one company at a time, through interviews and reading. So it's a little harder to screen on that. It's possible on qualitative measures, but you'll have to just do it one company at a time. You have to figure out what your universe is. This gets back real closely to what we did in paper one, exam one. You talked about US large cap, growth, value. So what is your universe? If I use the Russell 3000, that's all US stocks, essentially. Not exactly all, but it's the majority of US stocks, at least from a market cap standpoint. So it includes large cap stocks, it includes mid cap, it includes small cap, it includes value, it includes growth. So it's everything. You might be a small cap value manager. In that case, you might just start with the Russell 2000 value index, which would be 1,000 stocks that Frank Russell classifies as small company and as value companies. So your universe that you start with should be somewhat consistent with whatever asset that you're investing. Very few stock managers use the entire Russell 3000. Most are somewhat limited to either large cap or mid cap. They might be limited to value or growth or core, but it's unusual they're going to do the entire Russell 3000. And especially globally, it's really hard to find managers that do stocks throughout the entire globe. Most of the global managers, those that will do any stock anywhere in the globe, they tend to be very quantitative managers. And that's something I probably should have said in their philosophy. There are some managers that are very quantitative and some that are more qualitative. The larger your universe, the more quantitative you have to be. The smaller your universe. So I know some managers that manage real estate investment trust stocks. There's not that many of them, maybe a couple hundred. And so they can be much more qualitative. But if you're going to be looking at 3,000 stocks, there's no way you're going to be able to sit down and read the annual reports of 3,000 companies. You can't interview management. You can't attend trade shows, investment conferences. You don't have enough time to talk to that many firms and research that many firms. So you're going to have to let the computer do most of it. That's the process. How do you get from a large universe of stocks down to, say, 150 stocks that you like, that you want to buy, or maybe 100 stocks? Highly concentrated portfolios may only have 8 or 9 or 10 stocks. It's not unusual for managers to have over 150 to 200 stocks, but the more quantitative the manager, probably the more stocks to own. The more qualitative the manager, probably the fewer stocks they have, and the more concentrated their portfolio will be. But that's your process. If you want to learn process, we do this in the Investment Society, or if you don't want to do it through the Investment Society, I have some YouTube videos that show you how to go Bloomberg and actually do this part of the construction of building a portfolio. Is starting from a large universe. We use the Russell 3000 in the Investment Society, but we break it up by sectors. So we have a tech sector, we have a banking sector, we have a healthcare sector, And so rather than looking at 3,000 stocks, I may be looking at 400 stocks or 200 stocks that do like consumer staples, might be 300 stocks. And you're not trying to find the best stock out of Russell 3000, you're trying to find the best consumer staple stock out of the 300 stocks in that category. So you have to limit yourself somehow, and that's part of your process. It's well defined. I might show you some here. I'll probably put it on pause, and I might bring up some that I can show you actual companies and what they do. Once you have a process, you've identified those 150 stocks, now you have to have a construction theory. So what do? Well, you could just put an equal amount in each stock. So if you had 100 stocks that you like, you put 1% in each stock. But then you have to worry about rebalancing. How do you rebalance it? If you put 1% in each stock and one does really well and one does badly, so now you have 2% in one of them and 0.5 in the other, do you bring them back both to 1%, sell the one that got up to 2% and buy more the one that only got down to 0.5? And if you do rebalance, how often do you do that? There's been many studies on that. The one that I see is quarterly makes the most sense. But there are many different theories out there on exactly when do you rebalance. There's a theory of momentum that stocks that are going up tend to keep going up, and that might encourage you not to rebalance too much. If a stock went from 1% of your portfolio to 1.5% to 2%, it's got strong momentum. You may not want to sell some of it and cut back because it's on a roll, and you may want to keep it in there longer. But there's been studies that say how often should you rebalance so you get as much momentum as you can, but you don't become overly exposed to one stock. So you can read those papers. There's plenty of papers out there that do that kind of thing. You can even just in a Google search, just say, how often should I rebalance? Is it typing? Yeah, sorry. How often should I rebalance my portfolio? And there's thousands and thousands of articles have been written on. Here's a good one from Morningstar. Rebalancing. Answer: investors often wrestle with this. Putting your portfolio back to what your strategic targets. Remember we talked about that on exam 1. So there's plenty of discussions on that, how often you should do it. The other consideration you have to think about with rebalancing is tax issues. If you rebalance, you want to think about, well, if I rebalance, I create realized gains, got to pay tax on that. So there are firms that are really good at rebalancing in a way that minimizes taxes, which is probably not a stupid thing to think about. If you want to don't want to maximize your return, you want to maximize your after-tax return, and how you rebalance your portfolio is important. And rebalance is important for whatever theory you have. So you might have a market weight. So if Apple is twice as big as F5, then you may want to put 5 times as much in Apple as you do in the other firm. There's firms that do what's called enhanced indexing. So if Apple's 4% of the index, they'll put plus or minus 4% of 4%. They'll go 0.25% above it, or above or below. So they might have 3.75% to 4.25% in Apple. If they don't like Apple, they put 3.75% in. If they love Apple, they put 4.25% in there. Whatever the market weight means what is Apple, what is their size versus every other company. And Apple, and obviously Apple, Alphabet, Amazon, these are large companies. If you don't have anything in them, you're taking a big risk because they're such a big part of the market. Well, enhanced indexer sees that and says, wow, if Apple and Alphabet and Amazon, if they're 2, 3, 4% of the market, we better make sure we have at least 3 or 4% in there in those stocks, even if we don't like them, because if we're wrong and they really move, we're gonna lose a lot of money. You might have a model. There are at least a lot of hedge funds and quantitative managers that they use models that tell them when to buy a stock, when to rebalance, how much to put in there. They look at trading costs, they look at bid-ask spreads and other things we talked about earlier in the semester. And that also gets into optimization models. They try to build an efficient frontier in a way that the way they allocate to each stock gives them the highest expected return. Those are really hard to do because you have to build so many assumptions to get that to work. But that's the construction side. So if you had a portfolio, if you're going to run somebody's money for them, if you're running a portfolio as a portfolio manager, this would have to be part of your strategy. There's several articles out there that say equal weighted works very, very well. If you do equal weighted, what you're essentially doing is you're over allocating to smaller companies and under allocating to larger companies. Because if you equal weight, let's say Apple is 4% of the market and F5 is 0.25% of the market, and you put 1% in both, then you're over allocating to the smaller company and you're under allocating to the larger company. And so one of the reasons equal weight does well, and it's also a growth versus value. Remember, growth companies are more expensive than value companies. So if you're equal weight, you're just automatically over allocating to value companies and under allocating to growth companies. So the one of the main reasons equal weight might do so well historically is because value stocks tend to do better than growth stocks, and small company stocks tend to do better than large company stocks. So if you equal weight the portfolio, you might have that issue of that you're really not, it's not the strategies that are doing well, that you're actually taking a beta risk of over allocating to small cap and value. There's been a new approach called fundamental weighting. Robert Arnott is the person to go through for that. He's been a big advocate for this. He pushes this strategy very, very hard. There's some that disagree with him for the very reason I just said. Fundamental weighting means instead of putting 4% in Apple because they're 4% of the market, you instead use something else as your weight. It might be their net income, it might be their revenue, it might be their assets, some accounting number to say, well, if Apple's revenue is 3% of the revenue of all the stocks in the market, then put 3% in Apple. That would be a fundamental weighting. That's more used for an index fund. So rather than using market weights in an index fund, you use fundamental weightings, but you could use fundamental weightings in an actively managed portfolio as well. So I encourage you to look that up, fundamental weighting with Robert Arnott. There would be plenty of articles on that. Arnott's probably the most famous person on that. There's a Wikipedia. Here's Seeking Alpha as a response to Arnott. There's some people who don't like it, and it's exactly what I just said, is that it's not really, it's nothing more than taking advantage of the small cap value bent. But you can see there's plenty of articles. Robert Arnott is one of my favorite writers. He's an incredibly good writer. You should read Robert Arnott's stuff. I really encourage you. He will open your eyes to a lot of things. When he speaks at conferences, boy, the room empties up and people are running back and making trades in their portfolio because he's very convincing, has really good research. So yeah, I strongly recommend you read some of his articles. All right, so there's the portfolio construction. You need to think about this. You don't just randomly put stocks in your portfolio. You got to know how you're going to put stocks in the portfolio. In the investment society, we follow an equal weighted strategy, but we do break it up companies between large and small. So we'll tend to have 2% in large companies and 1% in small companies, and we rebalance anytime we get, so we have sector weights, so we try to put 4% in each sector. So anytime a sector gets to 4.4%, we sell it down to 4%. Anytime a sector gets to 3.6%, we buy back up to 4%. So, you know, and then I'm watching individual stocks to make sure we're not over allocated any particular stock. And then the last thing you have to worry about is risk management. Risk management really comes down to your sales discipline. Stock investors have a big problem. There's a psychological issue that makes especially retail investors do really badly because of this. But it's the issue of sell discipline. Retail investors, when they buy a stock, if it goes up 10%, they just have to sell. They have no trouble. They get nervous. They say, wow, the stock's up 10%. I made a good decision. Let me sell. I'm going to lock it in. I don't want to lose that. And then they buy another stock and it falls 10%, and they don't want to sell it, because if they sell it, they have to admit they made a mistake. And then it falls 20%, and then 30%, and 40%. And finally it falls 50%, and they sell because they just can't take it anymore. And that is so common. Retail investors, they sell their winners too fast and they hold on to their losers too late. And that's the same thing even sophisticated, well-trained CFA Portfolio managers, they do the exact same thing. So one of the things we ask for when we're hiring managers is, what is your sell discipline? So if a stock has fallen 10%, are you going to sell it? Say, we messed up, obviously we were wrong, let's sell it. Some people say, well, sell us any stock if it hits the price target we have for it, or if it falls 10%. So if it's obvious we made a mistake, let's cut our losses and let's sell. Or if it does jump up and we had a price target of $120 and it jumped from $90 to $120, we're going to sell it because it hit our price target. So yeah, you have to have that risk management, and boy, that's extremely important. Let me put this on pause. I want to bring up an example of this so you can see exactly what I mean with an actual firm. All right, so this is a collection of portfolio managers, what we call pitch books, and there's several of them I have here. If anyone is interested in this might give you some ideas for building your own philosophy. This first firm, I forget the name of this firm. I think it's Marcap. I had the word M-A-R in it, a Spanish word for ocean, so I'm not sure exactly. I can't remember the name of the firm. It was two gentlemen. They were friends, went to the same school, worked together, Goldman or somewhere, and then they decided to start their own firm. Just can't remember the name of the firm. It might come up here a different page, but just like I said, they have a philosophy. So they're looking for firms that are ability to grow shareholder value, wide moat. That word moat's pretty important. That means they're looking for businesses that are protected from their competition. They look at the quality of management, and they're looking at mispriced stocks. Here's their specific criteria: faster than expected growth, large margin of safety, large moat. That's what they're after. A large moat is not something you can really screen on electronically. That's more subjective. And then here's their philosophy shown in kind of categories: early growth, decelerating, recelerating. So that's the type of companies are looking at a little bit more of their philosophy, how they distinguish between different types. There's the firm Mar Vista. And here's their process. Like we said, the second thing is the process. They start with 500 stocks. They get down to 150. Then they do an evaluation. So the 150 are those criteria they talked about. I know it's harder to see because it's kind of small. The criteria they're looking for, like a wide moat. And then valuation, they do margin of safety. Margin of safety is a really common term as well. Margin of safety is, if we're wrong, how much can we lose? So we think the stock's worth 150. It might only be worth 110. It's currently trading for 120. So our downside's not that much, but we have a lot of upside. That's what margin of safety is. And then portfolio construction, just like I said, how do they do the weightings? The weightings is based on growth, margin of safety, moat. And then the last thing, they follow exactly my work, and you'll see this a lot in pitch books. Then their sell discipline. If the stock reaches its price target, if they find more attractive opportunities, if they have a strong opinion change on something, not a strong discipline, but it is there. So you'll see this a lot. So I have several more of these, a lot of other companies and what they do. You see more quantitative managers, like something like this. It's really, really, really quantitative. You see the process, sell discipline. You'll often on the process, you'll see something like a pyramid. You start with this universe, you come down to this. So just to let you know, this is what people do in practice. So it's not. Oops, sorry. I'm not making this stuff up. It's pretty common. I mean, that's something for you to decide. If you're going to interview with a firm that as an investment analyst, you're trying to get into that, you have to go through this yourself. You cannot go in an interview to be on the investment side, whether you're doing equity research or any kind of investment research, fixed income research. You cannot interview for a job if you have not worked through this yourself. Now they don't care exactly how you do it. They want to just know that you're interested in this and you're doing this with your own portfolio, even if it's a paper portfolio. So some have some theory. The most popular theory out there is probably GARP. I might have mentioned GARP earlier. GARP is growth at a reasonable price. So if you can't figure out what to do, then just do that. You're looking for firms that are growing, but their stock price is not too expensive. That's GARP, growth at a reasonable price. How do you measure that? Well, you measure it based on firms whose earnings have grown fast the last 2 or 3 years. But they have PE ratios that are lower than that, or a PEG ratio that's lower. This is not complex. You don't have to build something that's a massive model with 40 sheets in it and complicated formulas to be able to interview well in a job. The Investment Society helps a lot. If you want to join the Investment Society, I'm not pushing that, but I just let you know we do exactly that. So it's a good way to actually build your own process because we go through that from scratch. But there's other ways to do it. I've got YouTubes that show you to do it. So that's the idea. Even if you're not interviewing for a job, you might do this just for yourself or your own money. If you're interested in sometime becoming a portfolio manager, start as early as possible and start doing this kind of stuff. All right, so now we get to my favorite part of the class, and that's derivatives. So next few sessions, we'll take it slowly. There's some complications here that are going to be pretty tough. We're losing a class because of the way they restructured semesters, so I'm glad we're starting this a little early so I can make sure we get through this. We have 2 exam questions left that we have not done yet, we haven't covered yet. We'll cover everything in the team questions, so your team questions are following actual exam questions, so that's good practice. And so I'll show you those 2 exam questions. One of them probably cannot ask because it'd be way too simple to ask on an exam. Because it was just, since I can't make it closed book, so I'll probably overemphasize the last exam question, which is an options question. So next session we'll get into derivatives, and we're going to be doing it in detail, and I'll give you some research that you can do on your own if you want to get into this more. It is one of my favorite areas of finance.